Welcome, everyone, to our Bloomberg webinar on the new wealth playbook, alternatives and the next generation of clients. I am Merryn Somerset Webb, editor-at-large for Bloomberg UK Money, author of the weekly Merryn Talks Money newsletter, and most importantly, host of the Merryn Talks Money podcast. And I will be moderating this afternoon's panel. Now, with me, I have John Stepek, who is my co-host on the podcast, senior reporter here at Bloomberg and author of the daily Money Distilled newsletter, which, if you don't read, you really, really should. Also, I have Charlie Morris, Chief Investment Officer and founder of Bytetree, a leading provider of investment research in traditional finance and digital assets, which is what we're after him talking about today. Also with me, I have Jean-Damien Global Head of Investments for Barclay's Private Bank and Wealth Management. So thank you, all three of you, for joining me today. Now, can I please start with you? We are going to define our terms. We are talking about the next gen of clients. What do we mean when we talk about the next gen?
That's a good question. I think for us, next gen are typically children who are really developing a sense of wealth. They're interested in investing. They're curious often. They're active. They're very active and they want to be in control often and excited. And next gen for us is a period for our clients where it's about engagement and trying to understand them better, I think.
Okay, so we're talking about the newly well-off young.
Correct, yes.
And the inherited. They're beneficiaries of the great wealth transfer.
Yeah, which is the biggest one happening soon, as we know. And they're learning and they're passionate often with purpose beyond returns. So capital is not the only thing that we discuss. There's a lot going on at family level, family dynamics, capital more than returns. So the discussion often with next gen goes in many directions. And what is the same as the old gen is a sense of having some kind of growth and preservation at the same time, which is interesting. You see, it's a different dynamic than entrepreneurs who are creating the wealth. Often next gen, for us, are taking the wealth and trying to figure out what's going to be the purpose of that wealth for the next generation.
Okay, excellent. We'll definitely talk about that bit more in a minute. But I want to continue defining our terms and ask you, John, perhaps, to explain what we mean when we say alternatives.
Yeah, alternatives are basically anything that isn't listed equity or listed bonds. So you'd be talking about private assets, private equity, private credit, obviously been in the news a lot recently. Also in the more kind of financial side of things, commodities, pretty much every commodity, either direct investment in commodities or other ways into commodities, derivatives like futures and options. And also, I suppose, in a slightly further away from the financial side, kind of like collectibles, so and trophy assets. So anything like art or wine, or coins, even
gems. We did a great podcast on gems the other day. Vintage jewellery,
anything that fits into the sort of almost like a kind of hobby turned into a financial vehicle, classic cars, that kind of thing.
Real estate, did you mention real estate?
Real estate, yeah.
We can't call that an alternative?
It is a form of alternative. It's probably on the cusp, I think. But yeah, commercial property would be the other one. I mean, and also anything that's somewhat less liquid. I think you can almost think of like an alternative asset is often something that's less liquid. Although that's not always the case. Obviously, plenty of commodities are perfectly liquid. And obviously, gold is broadly an alternative asset.
And commodities we divide up between, listed miners for commodities, for example, would not be an alternative, but holding a pile of gold in your basement or buying a copper ETF would be an alternative. Okay, fair enough. Right, Charlie, there's one more alternative, right, which slightly newer alternative.
Oh, is that Bitcoin? Is that where that question is going?
That's where it's going. So. Not just Bitcoin, crypto in general.
Oh, crypto in general, okay.
But do pick up on what
I just want to pick up on the definition of alternatives. And I would say that you could also talk about cash flow and non-cash flow, so financial and non-financial assets, And so when you look at a hedge fund, I'd say if it's long short equity or something, it's a strategy. It's not really an asset class. And I would say the same is true for many things like private equity. It's just a liquidity thing. It's obviously long-term money and that sort of thing. But the true alternatives don't revolve around money. They're something else. So you've got the commodity sphere, you've got the digital asset sphere or the crypto sphere, and the collectibles that John pointed out. And also, liquidity is essential to that. So when you look at the liquidity, something like gold is the vast majority of the commodity market. And there's also oil, but of course it's not an investment. Oil is it's a futures contract, whereas gold can be held. And then again, when you come to crypto, 75% of all crypto is Bitcoin, and 25% of the other 1 million coins, or however many there are, is not Bitcoin. And it's very similar to gold versus the above-ground supply of gold against the above-ground supply of other commodities. So I just think that's a very good way to think about it. And I think the financial services industry has been hoodwinking people for years, trying to cool things to alternatives, put the fees up and that sort of thing, but they're not really.
Yeah. Can I pick you up then? Let's stop on private equity,
sure,
which is constantly called an alternative.
Yeah.
And John and I talk about this a lot on the podcast, and we say, well, private equity is just equity that's more expensive and less transparent.
Yeah.
It's the same thing.
Yeah, absolutely. I mean, private equity, it can be very good, but of course the disparity of returns in private equity funds is vast, whereas if you buy an index fund, everyone gets the same outcome. So there's a very different sort of fundamental thing going on there.
Okay, but go back to crypto. Can I call it an asset class?
Well, I think so.
Can I call Bitcoin an asset class?
Has it been granted permission from someone high up in financial circles?
I don't know. I don't know what the rules are here.
Well, there are rules, of course, and that is that if it's created by the Federal Reserve, the Bank of England, or Goldman Sachs or someone like that, then of course it's a legitimate thing. But because it came from chaos and it came from the cypherpunks and that sort of thing, it's never been accepted by the financial services industry. So it's where it came from. It came from the wrong postcode.
So not an asset class.
And that's why they don't like it. And everything else sort of if it comes out of Goldman Sachs, then it's very good. You must buy it. And so there's that. But I think that it is an asset class, absolutely. It's something completely different. And, you go back to the history of asset classes. We probably started off with, I would think commodities must have come first, the first loaf of bread. And then we progressed from there with debt and then equity in the, 13th century or something. And then it really kicked off in Amsterdam a few hundred years later. And most of the other things aren't really asset classes, but crypto has come along. It is completely different. It is definitely non-financial, and it is definitely not equity or bond or commodity. It's something different. It's digital. It's virtual, but it's real.
Okay, so we know what it isn't. Maybe we'll come back to what it is.
Yeah, what it isn't, perhaps we'll come back to.
No, we know what it isn't. What is it? What is it? What's there? We'll come back to use cases and all that in a minute. We'll have a nice row, everybody, in about 20 minutes when we've covered some of the other stuff. Right, let's go back to actual portfolios. So maybe your older gen have classic old-fashioned, or did at least have old-fashioned 60-40 portfolios, and apart from maybe a little bit in their vintage cars and jewellery collections, they were very clear equity bond. But that portfolio construction is no longer the default.
No, I think, to Charlie's point earlier, I think we've seen really the adoption of more asset classes. We can debate what an asset class is later, but clearly today, I would say the need for enhanced returns and diversification has led to portfolios being more than equities and bonds. Not new, right? Because we've been discussing hedge funds for a very long time. Yeah. Private equity now, private markets in general are more popular, so they're becoming really part of any asset allocation you can find on the street today. I think the question is the quantum, and the question is how you access for what kind of returns. But this is usually back to either skills, alpha, or an illiquidity premium, one way or another. So today, I would say, so for our own clients, if you come and you're not constrained, and we can have a very, very broad discussion, the starting point is going to come from what we call a holistic asset allocation discussion. Will come first and foremost with liquid, illiquid, long only, long short, and it will be a lot more than 60-40 for sure. That we see increasingly going into, I would say, more mainstream portfolio. I think it's been the norm for a long while, right? A lot of families have been studying U.S. endowments for a very long time and tried, to be as good as. Another topic we can discuss. And you see this kind of endowment spirit now trickling down up to or down to very small portfolios, because it's easier today to actually build a 50, 30 something.
But maybe it's trickling down exactly the point where it's maybe not going to work so well anymore. You know, those endowment portfolios have worked brilliantly during the great heyday of private equity.
Yeah, I think it depends on the objectives,
might be sliding to an end.
I think, look, for us, really, the key part of the job is to define a plan, like a goal and a plan for a client, and a plan that clients can survive over time, to your point, on the weight and the likes. I do think that if you can have the time to compound, which is such a wonder, being long, you know, and full-on equity risk is a good thing, usually. Whereas if your time horizon is shorter, clearly you should be a little bit less, like in the US endowment, and have more yield in the portfolio. So I think, look, the toolkit is wider. What doesn't change is the need to get the right advice and construct right portfolios, so you get the right outcome. I think the problem you have is maybe there's a bit of fashion going on, right? And it's all about that thing or the other thing. That may go to the lower end type client, maybe not always for the right reason.
So what's in fashion that maybe some people are having too much of in their portfolios?
So, well, a good question. I think with the next gen, to Charlie's point, we've been having a lot of discussions on digital assets for sure, that they own one way or another. I think I think it's an interesting topic. This is really probably something, it's an asset class we can debate, but it's really something that's owned across the spectrum, like from very, very wealthy families to actually mainstream investors, because it's easy actually to get to it. Again, it depends how you want to get to it, through ETF or real crypto, etc. So that piece for sure. I think the more private market, it's all about the democratization right now of illiquid stuff, which, you know, for me, you need to stay true to having quality investment in those portfolios. So you need to know what you're trying to harvest and what you're giving up for more liquidity on the way.
Okay, well, let's imagine, all right, sake of argument, that I'm a 30-year-old investor. I know. And I've come to you, and I haven't really got any sense of what I want, but I know I'm a long-term investor. I don't require much in the way of yield at the moment. What am I going to get from you? Am I going to get 40% equity, 20% bonds, and 40 in alternatives? How's it going to work? Is there a default that you have?
So we have a framework, and clearly a 30-year-old, you know, you'll be in accumulation, so it should be really about equity risk premium one way or another, if you want. And then question again is like, what kind of illiquidity can you afford in bad times? You need to forecast for those bad times. We've seen, right, back in the day, I used to be a secondary guy as well. It's good not to be short cash. It's a good idea in general. So we built a plan you can survive in good time, bad times. So equity will be a big part, and the alternative part will probably be around a combination of equity or return-seeking portfolio type strategy, so more equity, and a bit of diversification on the way. So, but equity will be the dominant factor.
End, even though we can label some things alternatives, et cetera, in the end, there's going to still be a majority equity portfolio. It's going to be a 90-10 in the end, sort of thing.
Well, we'll define what the right cushion is for you, so you can sleep at night. But the point we just made earlier around private equity, it's equity with leverage, right? And it's liquid, so it's equity again.
And our concern, and John and I have been talking at this stage, is the democratization of private equity is not necessarily ideal, right?
Well, the timing, isn't it? Because I suppose this is the other thing, isn't it? Like private equity benefited from ultra-low interest rates for a long time, but also from the fact that it was small and now it's big. And I think one of the things you were mentioning kind of made me think, if we're talking about illiquidity, you should be getting rewarded for taking illiquidity risk. But obviously, it's at one point in this particular cycle that actually tipped, and people were saying, actually, you were paying an illiquidity premium as a psychological buffer to stop you from taking your money out at the wrong time. And I just thought it was fascinating how it so smoothly changed. The sale pitch went from being, you're getting paid more for taking this illiquidity risk, to the illiquidity premium vanishing and saying, oh, that's because you're paying more for the psychological protection. And I have to say, it left me a little bit sceptical about what the exact purpose is of adding private equity to a portfolio of publicly listed, easily accessed liquid equities.
And as John always says, if you want access to small companies in the UK, at least inexpensively, boy, have we got a deal for you on the listed markets.
Yeah, but I think no, you make a very good point. I think at the end of the day, as Charlie mentioned before, it's about being selective. Is it a good idea to invest in the private equity market overall? We can debate. Now, we can see people who've been able, managers who've been able to actually deploy capital and actually make most of the return through operational improvement, long story short. Less leverage, less multiple expansion. If you can repeat that over time, probably you're happy to pay for alpha over beta, over equity beta. Now, to your point, yeah, I can see the point. I will always remember and point out a few clients towards the 07 vintages, right? 07 vintages, you make money. So many people just time and got out, right? You made money because you were stuck. But actually, it's a good thing to be stuck with skills. I agree. That's important. But yeah, I can see your point. I do think again, for the right portfolio with the right construction, it makes sense. Is it the holy grail and the magic wand? No.
Yeah.
No.
Yeah. Let's go back to crypto. Let's go back to Bitcoin. We talk about gold a lot, right? John and I, we talk about gold. We write about gold a lot. And when we talk about how much gold should you have in your portfolio, even if you're a gold bug, how much should you have? And the answer always comes down to, and this is Sebastian Lyon at Troy always puts this very well. He says you want enough for it to make a difference in a crisis, right? So 1% isn't enough, 2% isn't enough.
Very
3%.
good question this year.
What is enough? So in a crisis, you want your portfolio to have enough that it saves you to a degree. It works as a hedge when it is working as a hedge, right? Which it isn't always. But you don't want so much that in the good times, remembering that the majority of times are good times, you don't want so much that it pulls your returns down too much when things are going fine. So what is the answer? And for I think some of the Troy portfolios, it ends up being 9-10%, and then sometimes it goes down to 7%, and sometimes it goes up to 14%. So we tend to think maybe minimum 5-ish.
Yeah, well, I think the answer I'd point people to is the World Gold Council's study, which they did about 10 years ago, which it concluded 5 to 8%, which means 8% basically. Yeah. And they were being a bit cautious there. The central banks, of course, are now at 29% with their reserves, so they're taking it pretty seriously. And you mentioned the good times. Well, we've had most of the times the last 25 years have been the good times, but gold has beaten the S&P, including after dividends. And so that's in 26 years, gold is ahead of the S&P still.
Has gold been constantly anticipating the bad times, perhaps?
Well, gold doesn't have to. I think it's a bit of a misnomer that gold necessarily goes up all the time because of bad news. I think a very simple way to think about it, particularly at the moment, particularly post-Ukraine 2022, is that gold is an important piece of the central bank reserves, always has been. When those reserves are growing very, very quickly, the gold price is very, very strong. And when those reserves have been growing more slowly or indeed contracting, then the gold price has been weak. And so, people ask about this year. Well, when they have got problems in the Strait of Hormuz, and the central banks who are very wealthy in that region, they've got problems right now, they need some liquidity, so they're selling gold. Not all of them, but some of them. And so at the margin, there's less gold buying in 2026 than there was in 2025. Yeah, and that could be one of the reasons. There's also the unwinding of speculation, but that's all another story. But I think the bottom line is, what's the right weight of gold in a portfolio? My view would probably be 5% if you're bearish gold and 20% if you're bullish gold. Have a view. Okay,
have a view and take it, but no less than 5. All right. So with that in mind, what about Bitcoin?
Well, there's a question, and I have to revert to my bold index because I couldn't possibly know the answer intuitively. I would have to go and do a little bit of financial maths. And if you do some volatility, I'd be interested. At Barclays, do you use volatility to do asset allocation? In some ways?
It's part of it.
Yeah. Indeed. It's an important input to a lot of people who do decide how much allocation to have to various things. And cross correlations and so forth. Yeah. But Bitcoin and gold have low correlation. High at the moment, possibly, but generally speaking, over the last 5-10 years, they've been very low. And the volatility matching the risk weighting would come out and say about 42% in Bitcoin and about 58 gold.
Okay.
So on that basis, if you're 8 in gold, then you probably should be 6 or 7 in Bitcoin. That might seem high to people, but the logic stacks up.
I get it. Would you ever put that much into a portfolio? You ever give someone a portfolio with 8% Bitcoin?
So that's a really good question. So I was waiting for it.
So you were ready. I'll say we didn't give you prep time.
No, no. So it is not part of our asset allocation framework. I do have those discussions regularly, almost less so, I must say, those days, with clients. So for now, so I agree with Charlie on the vol side, but we have not made the point of make it an investable asset as part of our asset allocation framework for now.
Okay.
Can we ask about that? Because, Merryn, to my mind, there's not a single private bank or wealth management firm in Europe that I can identify that is publicly allocated to Bitcoin on a discretionary basis. Not one firm. It might be the execution-only desks might have taken client orders, but not one single firm. And there must be, because we speak to people who are really bullish and who really like it, who are with senior roles at these firms, and they get blocked by the system. What is the influence? Sorry to take over there. But what is the influence? What is the influence of the system on allocating to Bitcoin?
I think it's a good question. I think to your point, I think on the one hand, clients who are less constrained, right? So think family offices, allocations have happened, right? They've happened already, and really the discussion usually where I'm quite often out of my depth is real crypto allocation versus you buy an ETF, right? This is really, to me, the kind of a deciding factor of those families. Some people are actually really into it, and which is fine, because if you actually go to the actual logic of crypto, you should actually go full speed, right, on the thing.
So that's a bit like the difference between owning your physical gold and holding an ETF
100%.
that reflects gold. It's the same sort of...
The same story, I agree. Except that the wallet thing that I did spend time on gets complicated relatively quick on the actual thing. Whereas, I think you have a point on like, you move to more retail investing. I think all of us are watching a little bit the environment and what's the spirit in terms of having a recommendation on digital assets, which I think it's fair to say that we've seen very varied behavior on that spirit. So I do think the tide is turning a little bit.
Okay, let's pick up on this idea of the next-gen client wanting something different to the older client, and exposure to digital assets is part of that. So I would assume that everything that you worry about, no private banks, etc., providing it over time, if this is what the next gen client wants, this is what they're going to get, right? At some point, someone's going to override that system and make sure that everyone can put an allocation into digital assets one way or another. So that's one thing that we know that they want, or we hear a lot that they want. And the other thing we hear a lot about is what you mentioned earlier, which is about them wanting a portfolio that has some social purpose or has some impact to it, or they want to have a kind of ESG overlay that maybe older clients don't necessarily have. And we hear this an awful lot, and John and I talk about it a lot on the podcast, but in the end, when people say, what does your client want, what the client really wants in the end is to make more money, is to protect the money that they have and make more of it.
CPI
so
plus,
in the end, while you have all these conversations, and I know that wealth management is becoming a much more empathetic business than perhaps it used to be, and client empathy with your client being a big deal, is it really the case, in the end, that the new generation of clients is prepared to give up in return for social purpose or impact?
Good question. I think it depends a little bit. There's clear. We're facing more questioning, more dialogue on the impact of capital beyond returns. I think that's true. And from where I sit, I think we're active from Asia to here, Africa, Middle East. It's a relatively common theme. Takes different shapes and questions, but I think next gen has in common across geographies to question a little bit more the impact of capital. When it comes to looking at returns, so the way we think about it is to have actually benchmark, for instance, which are the same. So you don't adapt the benchmark and you should perform whatever the way. So I think that's usually the trade-off, and this is where you end up back to purpose, having not really new discussions, frankly, in terms of do you actually bias your actions towards capital with impact, or do you maximize return to actually have more philanthropy going on and helping, if you want, without the return, or with the return, but with the capital and no return expectation through philanthropy and these kind of actions. So I think right now the topic is really more about understanding our processes and what do we take into account, do we have ESG integration?
Yep.
How do we look at the impact of capital of companies we're investing into? It's difficult to quantify the trade-off, which is why, again, we're using same benchmarks for everything. I think where you do see a difference is probably in private markets where you have pure impact investing, which really comes with purpose first. That's different. Like, you go Article 9 type spirit, but further, actually, in private market. That's probably the closest expression, and we do have more queries on that.
More interest in it.
At the beginning, it's clearly stated, it's impact first.
Yeah. Yeah, you may get lower returns, and
Correct.
you accept that.
100%, yes.
Interesting. When you made the Bold Index and you were talking to people about it, did that come up?
Sorry, which
is
bit?
this an ethical index? Does it work for an ethical portfolio? Does a gold and Bitcoin combination, taking into account mining, energy use, all these things, did that come up as a conversation?
It didn't, but I think that both gold and Bitcoin are heavy users of energy.
Yeah.
And so is AI. The world is a heavy user of energy.
Yeah.
And if you want to grow, then you need more energy. Energy is at the forefront of civilization. So I would like more energy so more people can be civilized and have a better life.
Yep, I'm pro-abundance as well.
Yeah.
Absolutely. So this didn't come up in your conversations with index creators, with possible buyers?
No. I mean, I think that I think that's one of the reasons why Bitcoin and gold are valuable, because if they didn't require lots of energy, then they'd be...
what would they be?
They'd be readily available and they'd be printed and, easily accessible and all the rest of it. Yeah. So there's got to be something. It helps with their scarcity and all that.
Yeah. Yeah, okay. Don, we've talked about this a lot along the way, and we keep seeing surveys, don't we, showing that people are very, very keen on the purpose of their investments until they see themselves losing money.
Yeah, I mean, I think your average person feels like that, because if that wasn't the case, then we wouldn't constantly have bubbles. Because, bubbles are just people chasing the money regardless of what the bubble is in. And I think it's absolutely fine you should have your own red lines about what you invest in. I think that people need to think very hard about what those are low. Like lots of people, for example, the obvious one is tobacco. Lots of people won't invest in tobacco because it's often hard to see any kind of upside from providing that kind of product. But at the same time, every other kind of overlay comes with trade-offs. And you can't just turn around and say that, well, I'm not going to invest in an oil major because they pull oil out of the ground and it gets burned in cars, and then well, you can give up driving yourself, particularly if arguably people who are using these services at this level will be fairly wealthy and presumably consumers of fossil fuels and things like that themselves. So I tend to think it's a luxury item. And it's a nice to have if that's something you want. But if there was an obvious way kind of detracting from the returns, most people would probably think about it twice.
So all in all, jury is probably out on what the next gen client really wants.
Well, actually, we've done a survey on purpose recently, and the key takeaway for me was really about next gen. 40% of next gen, as far as purpose, is really keen to see clear metrics, clear KPIs, a lot more granular than the older generation, which was more general purpose, if you want. So you do see, I think, that goes together the more sophisticated framework you see actually for philanthropic investment or purpose investing, impact investing. So I think you see next gen being very willing, but willing to see the proof, if you want, a lot more. Which the good news is we have so much more data now. It's like
well, I was going to move on to this. You have so much more data. You have a new AI capability. You have a much better capacity to create metrics around all this kind of thing. This is one of the ways that you can embed AI in your processes.
So early days still, but I think talking here, I mean, data sets are just fascinating, and you see more data sets coming our way every day. I think from more a next-gen perspective, back to your question, I think what's really, really interesting in AI and data set is really the ability to scale high touch at the end. It doesn't seem intuitive, but we're going to be able to be a lot more high-quality advice enabled through AI, fundamentally, and knowing so much more about your own circumstances, because our own data sets we can leverage, which will be a big enabler, I think, in terms of helping enjoying the compound of investing at the end of the day, which is really, really important. I think that's why often with next gen, back to digital and excitement stuff. We did another survey. We do a lot of surveys on private market investing, and what I found interesting is millennials, according to our survey, are like 85% comfortable investing in private market, whereas baby boomers were like 62 or 65, something like that. However, the millennials were very keen, but had short-term horizon, which illiquid short-term horizon. So I think we need to manage the excitement, the enthusiasm in new stuff, as well as continuing to educate on the plan that actually, if I know about you, we can construct a good plan. Rule of 72 in 10 years, I can double your capital with 7% return, right? Yeah. So it's good. Good to shoot for the moon. Go for your 10x, 15x. But sometimes being boring and cruising is good as well.
Yeah, so with all this innovation in products, you're running into this difficulty of trying to balance innovation, excitement around innovation with actual risk management.
Correct.
With how can we really make this work for you a long time? And it sounds exciting.
It is exciting, and I think next gen in particular often is willing to be more in control, which is great. As I guess, Charlie, I'll be keen to get your views, but timing the markets is really tough. Really difficult to be a good macro trader. So if you're willing to be more in control, you've got a lot of data set coming your way. It's tempting to get in and out.
Presumably, the last thing the wealth management industry wants is clients who want more control. I mean, it's not helpful to be second guessed, is it? What you want is a client who gives you their money and then goes away for 6 months, pops in for lunch, goes away for another 6 months. Not one who's looking at the macro data themselves and attempting to time the market.
Well, I think, to be fair, I think it's been going on for a while. The fact that while, of course, we really like to be in charge, and we're happy to be in charge, a lot of clients, and particularly, again, in next-gen type context, want to be involved. So they have their own investment committee, we may join their investment committee, etc. Or, you see that as well in our direct investing digital platform in the UK. It's like you see those £6 a trade type activity. They want to be part of it. So no, for us, we don't see that as it's an opportunity for us to engage with more people. And I think the data point and AI will enable us to engage at scale. That's the difficult thing. Before, like to have this kind of two-way dialogue, portfolio construct together, it didn't scale much. Today, it's scaling more and more thanks to AI and tech. So that's actually exciting.
Okay, so
please, there was one thing I did want to ask. It just came to me there. So basically, the younger generation, you're saying they've got shorter time horizons. How much do you think that's a result of the returns background they've grown up in? Because they've seen something like Bitcoin that has literally made people kind of millionaires, billionaires, over a very short period of time, and even something as ordinary as the S&P 500. That's done spectacularly well over the last 10 to 15 years. And do you think they have a perhaps slightly unrealistic view of long-term returns because the recent long-term returns have been so good?
I think you have a point. I think and as we speak, it's probably, again, accentuated by recent events. I think I think back to next gen, having keen interest in purpose, in opportunities which are bigger than life to deploy capital. It's not boring. It's interesting, and I think it takes you to get maybe a zero to step back a bit and say, hey, actually, maybe I should have a longer plan and portfolio construct. Actually, but it's very true, and we've seen that right call it 19, 18, like the rise of people doing direct VC deals was very, very, very big. It's less big now, you know. Yeah. So I think, it takes learning, let's say, to...
There's been an interesting little question come in on this, by the way. It's not quite time for questions yet, but I'm going to ask you it anyway. By the way, if you're watching, you can ask questions. We'll be doing about 20 minutes of questions at the end. So questions you have for any of my three guests, please do send them in. So this is really interesting. Has this appetite for risk from next-gen clients permeated the mindset of older high net worth investors? Really interesting, because I think we've begun to see that, haven't we, John? And people we talk to, people who write to us, etc. We've begun to see this exactly that thought that I can make a lot of money really quickly begin to move up the age range.
Yeah, YOLO for 80-year-olds.
FOMO is it across the board.
Yeah, well, I think you're right. I think I don't know. From what I see and the dialogue I have with clients, I think to your point, I think if I look at the last 3-4 months, frankly, like Q2, I mean, spectacular, right? We've had a really good quarter. But deployment to risk assets has been on the low side. So I think actually, a number of people are a bit skeptical, which, you know, it's like you have to combine geopolitics and the AI, revolution. I think I think people are probably cautiously optimistic at the moment.
Yeah, although interesting, I have noticed another dynamic of very high net worths being very, very heavily in cash, largely as a result of their crash experience. The ones who saw 97 towards 2007, beginning of 2020, etc., are much more significantly in cash than maybe the environment would warrant.
I think there's one other thing. You were talking about the next generation, and with the Barclays angle, it's the next generation with loads of money. But there's also the sort of Robin Hood crowd who haven't got loads of money, and they think that, they think they're the first young generation not to have any money. I don't think anyone had any money in their 20s unless they were very, very lucky. But you're right. They've seen Bitcoin, they've seen Nvidia, and they go for it. They hit it much harder than I think has happened before. And to your point, Jean, earlier, it's all so much easier to build portfolios.
Yeah.
I mean, when I started in this business, the ETFs were just beginning. And now you can just buy gangs of anything anywhere, pretty much.
Yeah.
And so it's just the whole thing has become...
And you can use AI to just help you construct a basic portfolio.
Yeah. Not sure if I would want to do that in a hurry, but...
You may not want to, but I bet a lot of people are.
Well, they're going to do it, and it will all come down together, of course, because the AI won't be looking at the stuff that's really boring and safe. It's just going to ignore it, isn't it?
But if I may, to your point, so we're also quite active, actually, in the savings to investment campaign here. And I think
not the squirrels.
No squirrels, yeah. And to your point, so like the level of equity exposure in UK households it's moved from 20%, 25% in 25 years ago to 10% now, right? Super low. So a lot of people are in cash, to your point, and really adjusted for inflation, it's just a bad idea. So actually, our thinking, it's more about. We talk a lot about people not being able to afford to invest. We actually disagree on that. We think actually we run another study where we evaluated that 15 million adults in the UK could have 600 billion sterling to deploy to investment. So we should be able to afford it. The problem is confidence. Access should be okay because today,
access is not a problem.
Yeah, we've just made it even easier on our side. Like we removed fee from our digital investment platform. It should be really easy, but the confidence element, the education element, is what needs to be done. So you can indeed deploy your 10K, 5K, 2K, and compound.
Yeah, there's another interesting one. I know it's not quite time for questions, but I'm just going to use this one as well because it's again interesting. I think you might have an answer to this, Charlie. What do you think about prediction markets, and how is this distorting the investment appetite for the younger group of maybe investors, maybe gamblers?
Well, they're fascinating, aren't they? It's where real finance or traditional finance meets the betting shop, even more so than you could ever accuse crypto of, even more so.
Even more.
I was just looking at Polymarket this morning, trying to figure out what England's chances were in the World Cup this week. 22% of the fourth, so we've got a 22% chance that we win. And then you can look at it for politics to see who the next chancellor is. I mean, it's all good fun, but I've never bet on on a prediction market, but I certainly look at it for information source. And it was spot on Burnham right from day one. It never gave Farage a chance in the by-election.
Okay, who's our next Chancellor?
According to that, it's Miliband.
Okay,
but your friend Helen Thomas has said it, so...
Yeah, everyone said it. In fact, Bloomberg did a survey, one of our Markets Life Pulse surveys, which didn't necessarily say that expected Miliband to be the next Chancellor, but that if he were the next Chancellor, he would be the least market-friendly possible.
He is. I mean, just look at Gilts the last couple of days.
Didn't we?
Just look at Gilts the last couple of days. This story's been slipping out. It's not a good one.
Anyway, prediction markets, do they distort the idea of investment, coming back to what John was saying about the distortions that we've seen in these?
Well, they're a derivative, aren't they? You're betting on what's going to happen, and you know.
Isn't that what investing is?
Well, it's
you're investing into a story. You're investing into an expectation.
This is key. Expectations. So you know, if you think about a game of darts when you're playing higher or lower, very simple outcome. You know, 10. Do you get more or do you get less? But then you can start betting on the idea of the probability of whether he's going to get more or whether he's going to get less. And that's what the derivatives markets do. And so you're just bringing derivatives into the real world, I suppose. And you know, can that change outcomes? Well, of course it can.
The democratization of derivatives.
Yeah.
That's all it is.
Yeah. It's interesting stuff, though, because this is a big deal, particularly in the US at the moment. But also, one of our US colleagues, Matt Levine, was writing in his newsletter this week about a sports betting ETF they've just filed the paperwork for in the US with the regulator. And it's not out yet, but the idea, it really is just an ETF which will be constructed of bets on, you know,
I
like
don't really
football
understand.
in America.
I mean, I really
Does the fund manager just decide
it's an actively
who's going to be the next chancellor?
Yeah, one of the other things is an actively managed ETF. So obviously, I always think of ETFs as being quite passive.
They're betting all day.
Yeah, so it's basically just an investment trust with bets on. Yeah.
No, but someone behind
Someone
the
is
ETF's got to
sitting
be
there
betting all day.
Yeah.
You get a professional bettor, basically. You're sharing, I guess, in the profits or the losses of a professional gambler. But I don't see how, for example, I don't see how that could ever be part of a balanced portfolio.
No. Well, it's a zero-sum game, isn't it?
Yeah, exactly.
But if it's the democratization of derivatives, if it's the democratization of derivatives, it's simply what you were talking about before. It's allowing the ordinary investor to move into an asset class once reserved for the very rich.
But it's gambling an asset class.
I was going to say I think we have to go back to basics, right? So like capital should sustain the economy. Equity is good. Equity, if you have time, you will go up. That's a good thing. Now, of course, we have seen, you know, arbitrage types of strategy have been around forever. I think, to your point earlier, this is where you start to see the, some manipulation of market, right, happening, which is where money is involved. You can actually tweak the game. It's good to stay into stuff that are a bit regulated, I think.
Yeah, real things.
Yeah.
Okay, we need to talk about some serious things now and to answer some questions, okay? We need to talk about the things I think we advertised we were going to talk about how AI, etc., would affect the wealth management business. So here we go. And we do have time for questions, so do send more in. I've got quite a lot, but more is good. This is kind of the key, the absolute key to the wealth management business over the next couple of decades. Technology and AI are transforming the investment process. Where do you see AI creating the greatest value for advisors over the next 3 to 5 years? Is it improving productivity, enhancing investment insights, or delivering a better client's experience? I mean, I would hope that it will be all three.
Yeah, I think it's probably all three. Yeah, I think what's going to happen back to democratization is what we're working on is really to help clients enjoy the high-touch service that you could only afford at a certain level, at a much lower level.
Yeah.
And that's really the revolution, I think.
Because you can use AI agents to do all the basic work that
can be
previously would have to
augmented.
be done by somebody. And you can concentrate on the actual client service, the face-to-face stuff.
Absolutely. But what we've seen in our experience, in our recent experience here is you do need human judgment at the end. Yeah. And as I'm sure you know, we had an attempt with robo-advice. It didn't work out very well. So we do think, and we've launched a month ago, a planning-led service with someone in the middle, an advisor in the middle. That is the opportunity, I think. Clearly, you're going to see a higher quality advice delivered at scale, I think, thanks to AI.
So it'll definitely improve productivity. I mean, I think we know that. Although it won't necessarily improve productivity in such a way that you'll end up getting rid of human staff, right? People aren't going to lose their jobs over this. They're just going to become more productive and hence better at the client-facing end.
Yeah, that's our own experience, really. We've actually really put back the human in the middle in that part of the advice process because that this is what's working.
Yeah, so the client experience and the actual relationship with the advisor should improve.
But clearly the data set you generate when you're a client of the bank, you can have access, we can have access to, it's just like, it's amazing. So the hyper-personalization we're going to be able to deliver to clients thanks to the data set augmented by AI should lead to better outcomes, I think.
And what about actual better investment outcomes? Are you seeing it? Are you going to be able to use it to improve your investment process, to improve the insights?
Yeah, I mean, look, so I'm more a quant guy by training, but I'm fascinated by the ability to go through research now through tools which are quite spectacular, right? So again, the insights is still required. Like, we value the opinion, we value the analysis, but how much you can process quick is quite spectacular. Yeah. That's for sure, and that's really moving fast. Now. Yeah, to the point of, again, is alpha going to disappear thanks to that? I think that's a wider discussion. I'm not sure. We've had the discussion before. And given how the dynamics are going in terms of markets.
Everyone has the same tools. What happens to the alpha?
Yeah, I'm optimistic on that. I think depends on the market, but we'll see. I mean, some excess, right? As we can tell right now in some part of the market.
Charlie, you construct portfolios. You must be finding that AI is changing the way you work.
Well, it's like having an assistant, so that's good, but there are better things you can do with it. I was discussing this morning, would I trust it to reevaluate our portfolios? The answer is no. Would I trust it to even book trades? No, I wouldn't. Not at this point, although we have experimented. And but as we grow to many more portfolios, then I think we'll have to. So I think that's the interesting part. So, but to answer that question, there's a lot of admin in having a client in the wealth management industry. That's solved by AI or improved by AI, and I think the client experience will be much better. But the most useful thing that the industry can do is deliver returns. There's no more returns coming from AI. There's no alpha coming from AI. Alpha's a zero-sum game, as we know. It comes from some and it goes to others, and the beta is the direction of and the returns of the market. And they're not going to be changed materially by AI over the long term either. So I don't think that anyone's going to make more money out of it in the next 10, 20 years. This current wave of excitement, it's not going to last forever, and once that's over, we just look through that. It's going to be back to normal, but I think that there's going to be a new bunch of actors who do better and others that lose out. But of course, the Buffettology will always win through long-term decisions. I think that AI will have no chance against long-term decision-making. Good decision-making, which is what value investors thrive off. So that stays. I don't think that changes at all. But the short-term shenanigans and the narratives and stuff, they'll just go even more crazy than they've already been.
I suppose because, as you were saying earlier, when we were talking about creating AI portfolios, if you're using an LLM of any kind, they're not creating new information or new ideas. They're simply collating old, or more likely recent information. So maybe the insights are not.
There's that, and so if they're just sort of really sophisticated Google in that sense, then I think there's probably not much edge there if everyone's got it. But I do think for the data scientists, it's a pretty exciting world. It democratizes it. So if 10 years ago, or Jim Simmons at that fund, what he was doing 30, 20 years ago, everyone can now do it.
Yeah.
You know what I mean? So I think it's going to be many more people benefiting from clever computers than there were.
Yeah, and hence, again, this sliding of the endowment model all the way down to the basics. OK, we do have more questions. Got to move on, and we've got 10 minutes left. Right, John, I know you're not a wealth manager, but I still think that that you might be able to help with this one, and then I'd love to hear your views on it as well. Looking ahead, what do you believe will differentiate the leading wealth managers over the next decade? Will success be driven primarily by investment performance, access to private markets technology, or the quality of client relationships? I mean, I know we always come down on this, don't we?
Yeah, I mean, obviously investment returns if you can do it, but if I'm honest, I think by far the more important thing is navigating regulation and government changes over the next, if you're talking about the next decade, then tax is going to be where the biggest value add, I think, for almost any wealth advisor will be. And being able to, I don't mean, when I say think outside the box, what I mean is somebody will turn around and say to you, well, actually, the best investment you need right now is a second passport. Yeah. And I know somebody who I can pass you on to. And also, I do think that, I mean, we've already seen a whole load of changes here in the UK in the last couple of years. And Britain is not the only country with a deficit and a debt problem. So I think we're going to see an awful lot of kind of government budget changes, and that will put a premium on decent tax advice, completely above board. Yep. But I think that's where they'll be able to add the most value. Again, that comes back to
hyper-personalisation, doesn't it? The idea that the whole portfolio, not just the investment portfolio, but the entire holistic portfolio of someone's life is understood by the wealth manager, and the tax can be fiddled with is not the phrase I'm after.
No, yes, not fiddled, optimised.
Optimised.
I think that's true, and I think that's where AI can come in as well. It's almost like when you were talking about, it's a bit like if you go to your GP and they actually have an AI that works, and it says, well, actually, you need to send this guy to, this specialist or that specialist. I think that's the kind of thing that you want. Well, no, I mean, that's in my dreams.
So you're in your dream medical world. Back to you on this idea of what will mean success in future investment performance, access to private markets, anything. That's it, by the way. But who knows? Client experience.
Yeah, we'll concur with John actually, and not perhaps again. I'm responsible for the investment business at Barclays, but I'm also responsible for wealth planning and advisory. So it's under one team, and I completely agree with you. I think the planning side, that's like the GP work you do at the outset, is so important. And probably more than ever, to your point. So I think the ability to build proper plan, quality plan that you can actually deliver through various segments of clients is where you're going to make a difference. I think the return side will be very important, but the return side has to be fit for purpose for the situation.
And if you've made a mistake and you don't have a tax efficient portfolio, whether you make 6% or 8% in real terms every year is meaningless,
huge difference.
Right?
Correct. Yeah, absolutely. I think that it's not by accident that we've launched this affluent service in the UK, which is planning led. First and foremost, this is really, really what we think is important. Clearly, return will be important, and education as well. Like back to the discussion we had before. Clearly, Charlie's point, like time should be on your side. Like this is a real competitive advantage. If you have time, it's great. Enjoy time and compound.
And that planning has to now really anticipate as well, doesn't it?
Yes.
We do almost nothing in the UK now except for talk about what tax might go up next and how it might go up and whether it might be indexed or not indexed, and whether the mansion tax is going to be on £1.5 million or £2 million, etc., etc. And basically our whole conversation. So as a planner, you've got to have a lot of anticipation for what might come or might.
Absolutely. This is where you actually get into real deep conversation with clients. Like I sit in a few conversations like this on wealth planning, wealth advisory, and it's really, people open up. Like you actually understand the whole family, all the dynamics, all the beliefs as well, like the values for next gen, etc. And I think it's really, really important. And then we can debate about Bitcoin, ETF, etc. But like that plan at the very beginning is so important. I think this is where you're going to make a difference. And again, AI will allow us to deliver that kind of a high-touch diagnostic at much higher scale. I think.
Yeah. Empathy, Charlie? Is that the key for wealth managers going forward?
Yeah, well, I think they're going to have to. I mean, going back to the basics, technology has just made their job so much easier than it was before. I mean, I joined wealth management in 1998, and we had green and black screens. You shared one between two people. You filled out a triplicate ticket, took it to the dealer, shouted at each other a bit, and then did a deal. And it's just changed so much. Yeah. It's changed. I mean, I think people didn't really know what the index was in 1998. There was one guy, I won't say which firm I worked for, but there was one guy who was having a 2:30 phone call and saying the S&P 500. He said the Save and Prosper 500 is opened up today, and this was a guy with 40 years' experience. And so I think the world really has moved on a lot in the last 30 years.
Okay, more questions. This one probably is for you because it's a little technical. As wealth management evolves to serve the next gen of clients, how do you see banks' expectations of third-party data providers and technology partners changing? What will define a successful partnership going forward?
It's a very good question. I think the tech infrastructure is really at the heart of our thinking, both from a client experience side and a resilience side, right? And it's an important topic these days. So we really want to create the best architecture we can to deliver great CX. We will not build everything ourselves, for sure. We're really happy to just partner with people so they can understand us. We're going to own really the one of the most critical part of the equation, which is the data point, the data set, right? It's going to be in the bank, and we'll be more than happy if you want to benefit from this ecosystem where people are doing the watch on reg development, to do things you need to do before you actually give an advice. And sometimes there's a lot of paper involved, and it's moving, it's changing now, right, as we speak. So I think we're very open-minded, actually, to partner with people. I guess question will be how many? It's probably a question like, in this world where you really want to be on top of your architecture security, how many partners can we have in terms of really understanding each other very well?
Yeah. And also you have to fully understand how they are using new technology and how they are using AI.
100%.
And suddenly you need to have a lot more oversight of the inside of every provider.
Correct. So we want to, I think, we've been involved for a very long time in supporting fintech, for instance. So we want to strike the right balance between innovation, but also like scaling resilience, so to speak.
Okay, couple more quick ones. Are wealth funds using data well enough to understand client behavior, preferences, and portfolio needs? Maybe not yet, but soon will be.
I think we're, in the UK, we're working very hard on the launching targeted support service, right? GBR. It's a large part of that. The understanding of the client behavior across all dimensions of the touch points they have with the bank, across actually everything, is a very big part. So it's actually happening fast, I think, and it's actually a very interesting discussion in terms of what how far you go, and what you need to plan for, knowing what you know on the client.
Okay, I want to just finish up because we're very nearly at the end. I'm asking you, Charlie. We've talked about, we've done the whole discussion. Is crypto an asset class? Isn't it an asset class? Is Bitcoin an asset class? But really, just stuck with Bitcoin. If you're constructing a portfolio and we talk about digital assets, what else is in there?
What in digital? What else can you buy?
What else are we putting in there when we're talking? Are we putting other cryptocurrencies in there? What's going into this?
One of the sort of credible things that have survived the last decade of innovation and all the rest of it. You've basically got Bitcoin as the only sort of store of value, the sort of a digital gold proxy, as it were.
Yeah.
Then you've got what they call the layer ones, basically the things that you can transfer assets with. You've got Ethereum, Solana, and Near, and things like that. And they're the home for stable coins, and for in many people's eyes, the future of markets generally. Because I think a lot of the people in the financial service industry who are pro-crypto believe that stock exchanges and bond exchanges will end up using that kind of infrastructure.
Yeah.
And so they're very real tech businesses, as it were. And I think the third category, really the exchanges themselves, things like Binance, and there are some other weird and wacky ones. And there's lots of other stuff, but it hasn't really got to scale or proven itself.
Yeah.
So those are the things that are coming through. But the fascinating bit, as I said earlier, just as the above-ground supply of gold is the vast majority of the tradable value of all the commodity markets, the above-ground supply of oil is actually quite small. Yeah, I mean, we use a lot of oil, but it's not really there as an asset. Commodities are overwhelmed by gold in investable terms, just as Bitcoin overwhelms digital as an investable asset.
Yeah. And
they're connected. They're all connected. So I think that's the interesting point.
Convinced yet?
Working on it. I think for us the tokenization part of it is really, really important. I think we'll see so many more clients coming and asking for us to, onboard an asset somewhere that's been tokenized somewhere else. We need to be able to do that more at scale.
No, but what you should do is do what everyone else does in the financial service industry and say, I love blockchain, but I don't like crypto.
Okay.
And
that is the perfect place to end. Thank you so much for joining me today. Thanks, John. Thank you, Charlie. Thank you, JD. That was very interesting, and I look forward to every private bank portfolio having 8.5% of crypto in it.
Bitcoin. It was 6% Bitcoin, it was 8% gold.
You said, yes, indeed.
But gold is the alternative, of course.
Thank you. And thank you all for watching today.